Wow. It is May the 20th, 2021. It's a Friday. That was the week. And we have a third member of our gang here. Last week, we talked a little bit about Steve O'Hare, the TechCrunch journalist who's doing some other interesting stuff now. And I said to Steve, if he promises to wear his hat, he can come on the show. And here he is. Mr. Hat himself, Steve O'Hare. Steve, welcome to That Was the Week.
Thanks for having me. I'm excited to be here, and I do have the hat.
We're thrilled and honored. And to kick off, I think Keith is going to ask you a couple of questions. So ready for a Keith question here.
Oh, wow. Where did you get that hat, Steve?
I got it from a place called Hats and Caps, I think. They do loads of hats. I went down a rabbit hole many, many years ago buying hats, but I love film noir and I love blues music, so it's like it's that kind of.
We should.
Oh, go on, Andrew.
Wow, if you and I had the hats too, we could have been the Blues Brothers today.
The Blues Brothers. Well, you definitely one of the Blues Brothers. I'd be the whatever the opposite of blue is. What would that be?
Yellow.
So I should tell you, my wife always makes me wear a hat when we go walking because she thinks I've got such pale skin that I'll burn my face off unless I wear a hat.
No, it's good too. When I started wearing it, like, I swear people then paid more attention to the hat and less attention to the wheelchair. So that's kind of how it started. I remember we were going to Nokia World once. Remember Nokia, the mobile phone maker? Like, I went to their big conference and I remember one of their executives came off stage, ran straight towards me, was like, "Hi, like, who are you?" And it was blatantly the hat. Like, yeah.
So the first time I ever met you, and I hadn't ever looked you up online, I was doing a talk at some conference in London, like Startup something or other.
I think it was Startup Grind, yeah.
Yeah.
In Westminster Hall.
And I'd never met you, so I had no idea whether you were 6'6", a dwarf or something in between. And the first, I can remember thinking, okay, I had to kind of reflect because I had no idea who you were. And the hat definitely was part of it, but the wheelchair definitely played a role as well. That must happen to you a lot.
I mean, you guys spent last week about 5 minutes saying how unique I was. And then I really liked that. And then Andrew backtracked and said, maybe I'm not that unique after all. So I'm like confused.
Yeah. Well, you can be both unique and not unique simultaneously. I think we all are.
Now, what Andrew doesn't know about you, Steve, is you actually got your own studio, haven't you? And you're big into music.
Yep, we've got my own project studio. You can't really see it because it's all like behind me. Yeah, super into music production. I mean, I've made films. I write. I'm that kind of creative person who can't really decide what they're really good at. So I try and do it all.
And where are you, Steve, at the moment? What part of the world?
I'm in London, in North London.
Whereabouts in North London?
In Tottenham.
Oh, nice. Well, not so nice at the moment. But whereabouts in Tottenham?
I'm like South Tottenham, so quite near to Wood Green.
Oh, okay. So the fancy bit.
I don't know. Don't think most people would agree. I guess if you go a little bit towards Stroud Green, kind of green lanes, you get fancy. But I went to school right next to the famous Tottenham Hotspur Football Club.
Yeah. So, I'm a fan. So I was. I first went to my first match was in 1966. Boxing Day 1966. West Bromwich Albion at home, 0-0. I was at the Champions League final in Madrid. All the other finals, so big fan. I'm a season ticket holder, although it hasn't been much use this year. And they're so bad now anyway. Do you still go to the games? Do you ever go?
I haven't been for years. I had a season ticket when I was a kid. I used to turn up to the ground so often and ask for wheelchair spaces, because they were sort of quite limited. And the women that worked in reception got so sick of me, they literally gave me a season pass. But that was many years ago. And then my brother used to work for one of Tottenham's sponsors, and he got access to the VIP box for a
Nice.
season off and on. So I definitely started going then.
And who's your favorite?
Andrew, can I ask you a favor? When you're not speaking, can you click on mute on your microphone? Because we're getting echo back from Steve, and I think it's coming back through your speakers.
Okay, so I mute.
When you're not speaking. Go on, talk, Steve. Let's check.
I'm going to mute for a while, so you guys talk for a bit.
Okay, yeah. How's that? That is better, isn't it?
Yeah, much better. So let me put this on screen. I want you to tell everyone a little bit what you're up to. I saw this in Sifted, which, by the way, is a very, very good UK publication, I think, in general. And it talks about your move from TechCrunch to a new basically, they're implying you're working in a grocery store. So what's really going on?
Yeah, so about 4 or 5 weeks ago, I quit my job at TechCrunch, where I was covering European startups and in particularly fintech. And I joined, and effectively quit journalism, and I joined a startup in London called Zap, or tryzap.com is the address. And it's like we're basically trying to build the future of convenience retail. So we deliver within 20 minutes, operate our own stores, and we sell kind of stuff that I guess in the US would be in a convenience store. So maybe a little bit akin to GoPuff, but definitely not like a straight up copy. We're doing things our own way. I was actually scooping their funding news when I knew the founder for many years, and he said, like, come and work for us. And I was like, okay, so what would I do? And we carved out this quite interesting position where I'm VP of strategy. So it's working with the CEO, reporting directly to the CEO, founder, and working on kind of internally a lot of stuff that we're doing so that it sticks to the company's principles and the consumer promise, and just, floating around, and also helping to tell the story outside the company in terms of like being the person that is actually going to be like interviewed. So I've done a lot of press interviews on record. I don't mean the comms, the PR. I mean actually like talking on behalf of the company. So it's a kind of way of keeping that journalistic, I guess, public profile, but also like, because I've seen a lot, and I've seen many companies do lots of good things and bad things, kind of helping to install some of those principles and ideas within the company. And it's so far been so much fun and so multifaceted, and like all the stuff I'm getting involved in, the challenges. But I guess one of the catalysts for making this big change of leaving journalism to join a startup, and I have founded a startup of my own. It's not like I've actually done this before, but this is at a bigger scale, is that the pandemic and the move to working from home kind of opened up a lot of opportunities for me, because I need to primarily work from home, if not completely, so I can manage like my disability in certain ways. And suddenly all these jobs that were kind of impossible have become possible because founders and VCs and other people at companies are more open to someone being almost 100% remote, right? It's like the progress has been overnight. And for me, that was quite profound, because I spent a year shielding, like literally not going out at all. And yet in some ways, which has been awful in some ways, right? But in other ways, like the world has kind of leveled, like with the way I work. And that's not going to last forever. And obviously I think hybrid is the future. But it just means that nobody now can say, you can't really do your job if you can't come into the office or commute or travel. Now people are like, we don't care how you get it done, just get it done, right? And I always used to joke that you got all these like founders and VCs claiming to be so progressive and so sort of iconoclast or whatever the word is, like, and yet on this one issue, they were always so nervous about letting go of control, right? And so, but at TechCrunch, I was always super autonomous. Worked from home the entire 11 years. Nobody ever questioned my methods. Just get the scoops, get the story over the line. Don't get sued. Job done. So that's what changed. Yeah,
I find that a lot in it's to do with the control freakness of the DNA of the company. So if a company is led by somebody who assumes that people are badly behaved and wants to see them to prove they're not, then you get this culture of snooping and wanting everybody in the office. But in a true team where everybody's pulling their weight and doing their job, you don't get that. So I think the pandemic has helped people who are more optimistic about their fellow human beings, let's say.
Yeah, I think I agree. And I also think there's look, I think some people are better at it than others, but I've had to do it from a pretty young, like really the start of my career. Like the most I've ever gone into an office is like 1 or 2 days a week, right? And that's been less and less over the years. So I think you definitely have to train yourself to be able to collaborate remotely and make use of all the tools we have. But we're spoiled, right? Nowadays, there's so many tools, so many ways of collaborating online. So yeah, for me, it's been just ironic that I say that all these kind of people that claim to be forward thinking, but it took, as I think I said in my article for the Sunday Times, like it took a pandemic to break the glass ceiling for me. But
yeah,
it's been great so far, and I'm loving it.
Well, I'm very tempted to ask you a whole bunch of highly intrusive TechCrunch related questions now that you're no longer there, but I'll resist. and because time is, we're already how many? We're 11 and a half minutes in. So let's give Andrew this signal, and let's move to the meat of the show. Andrew.
Well, your editorial this week, Keith, is on finding unicorns. We talked a little bit about this last week, about the skill in selecting, sorting the unicorns, the valuable, the symbolic, $1 billion. I don't know whether you're using this term literally or metaphorically. How do we find unicorns? How do we distinguish the remarkable startups from the trash? And I know, Keith, you've got some thoughts on that. You've got a new startup which touches on this. I'd be interested in Steve as well. Steve, clearly you've jumped on board a startup that you believe, I don't know whether it's a unicorn or not, but you must have decided it has value, and I'm sure you've had other offers in the past. How easy is it, Steve and Keith, to distinguish between companies that are going to bust or fizzle and companies that are really going to take off and become unicorns?
Maybe I'll start. And Andrew, again, if you mute when you're not speaking.
Yeah, I'll mute now.
But feel free to unmute and interrupt anytime you want. So it's an interesting thing. I mean, a unicorn is strictly defined as a private company valued by a private investor at $1 billion or more. That's what it means. And, sometimes that happens real fast. Like Clubhouse went from being certainly nowhere near a unicorn to being worth $4 billion in what's felt like a few weeks. So if things work out really well, unicorns happen very, very fast. And
I'd be interested, sorry to jump in here, I'm interested, Steve, in your take on Clubhouse. I've always suspected, I'm not sure how much proof I've got, that Clubhouse is not a genuine startup. It's the plaything of very powerful and wealthy VCs. And it can't be included as a typical startup, but maybe I'm being unfair. What do you think, Steve?
So I'm struggling whether Clubhouse is a feature, let alone a product, let alone a company, right? So I think the innovation with Clubhouse is they really lowered like the barriers to live audio streaming. They definitely did that. That's amazing. It's so easy to just onboard yourself and do a stream. And the serendipity of being allowed to pull in audience members and sort of temporarily put them on quote unquote stage, that is definitely an innovation in terms of no longer being to one to many, but you can also be many to many, right? So that's the positives. I got bored really quickly. I was really into it for about a month. I think user retention doesn't look great. Don't think they've innovated fast enough, actually. Maybe the echo chambers allowed them to have a false, like complacency. I don't know. So I'm definitely undecided. I don't know if it's a real deal.
No, that actually intersects quite well with. There's 2 articles this week about unicorns. One is my wife Jenny's piece from Crunchbase, which discloses that there's been 166 new unicorns since January. The second one is by Christoph Jans, who you'll probably know quite well, at least by reputation, from Point Nine Capital, who talks about false positives, as in SaaS companies that get very quickly to maybe even 10 million in annual run rate, but then never go any further. And you can become a unicorn by quickly getting to 10 million in annual run rate. And if you stall at that point, it's a huge mistake that you're a unicorn. So I think there's, Clubhouse could easily be one of those. And it doesn't even have 10 million in annual run rate. It doesn't have any revenue at all. So it could easily be one of those. So Andrew's question, which is how do you identify one? My method is, and I actually can share a screen here by unsharing my other screen. Let me just do that. My method really is all about data analytics, and it means you can't make a determination very quickly. What this is that you're looking at here, when I put it on screen, this is the Signal Rank Capital GP rank algorithm at work, and this is looking at unicorns since 2016, and it looks at which investors have found the most, and it scores them. So here you got Y Combinator, top of the list with a score of 3,700. Why? They get 60 points every time they invest in a seed round of a company that in the future becomes a unicorn. Accel are second. Now, if you break it down, which is what we do at Signal Rank, I can show you the angels that have done well. So Elad Gil, Mark Benioff, Mark Cuban, Alexis Ohanian, Ben Ling, Scott Bannister. These are all names I know. Scott Belsky. These are the people. Naval Ravikant, Jeff Weiner for LinkedIn. These guys have invested early in the seed stage of unicorns. Micro VCs, the leaderboard is Silicon Valley Angel is at the top. So what I think the answer to the question, how do you find a unicorn, is you follow the people that have a consistent track record of finding them, and you see who they're investing in. And then the second thing you've got to do is look at every company they invest in and distinguish between the ones that are on track and the ones that are not. So if you take Zap, your company, who invested in it is actually quite important. And how it's doing compared to the rest of their portfolio is the second thing that's important. And if you track those things and measure them, you'll find unicorns.
Yeah, I think you're right. I mean, yeah, I've always thought that whether you're talking about angels or seed firms or micro VCs, that there's a part of VC that most people don't really get, which is that it's in some ways it's really simple. Right? If you presume, let's take Europe, right? If you presume that Europe is producing better and better companies every year, and that's been a trajectory that's been going on for the last 10 years, then it stands to reason that the pool of good companies has got bigger and bigger, right? And then it just becomes a case of, you think about like super angels and some of the top seed firms, it's like, are you seeing all the best deals? And if you are you picking the ones that are going to be unicorns in the future? And can you get in on those deals? And so you see sort of in Europe, as the ecosystem matures, a lot of those seed firms and like they're starting to do more and more kind of content marketing, and they're always pairing up with the same pool of angels. So I think you're right, Keith, that you can kind of spot where it's going. But where the bit I never could figure out as a journalist is how much of it is a self-fulfilling prophecy, because how much is just network effects in terms of like, imagine if I started angel investing tomorrow, and I do hope to angel invest next year. Like, am I going to see the best deals? Am I going to be able to get in on them? And if I am able to get in on them or even see them, it will be because of my network.
Yep.
right?
Well,
So does that, does that make me a good investor? Does that make me a unicorn spotter, or just a good network?
A good network is 90% of it, because both Silicon Valley and London, and that's probably also true in Berlin and Paris and other places, there is a kind of an in crowd who share deals. And, so if you can get into the deals that Saul Klein does in London, or that Reshma Sahoni does, or Sitar at Connect, or, the guys at Kindred or Hoxton or Episode One, probably you're going to be in some good ones.
Or even the angels, right? Some of the super angels like Tavat,
Chesterman, Alex
Chesterman, yeah, right. We can probably name all, and you just described the networks I'm talking about, So.
That's 90%, and then I think the other 10% is not going into all of their companies, but having a bit of a nose for which ones are good and which ones are not.
Yeah. So
now, getting in is hard. Actually, I'd love your opinion about this. So, you know that I was with ADV for the last few years, and we developed this. We partnered with SeedCamp, and we developed this approach of offering SeedCamp when it ran out of money to keep investing in its best companies, because as a seed fund, it didn't raise enough to do more than a couple of rounds in each company. We said, okay, here's some free cash. You put it into the company in the third and fourth and fifth rounds, and we'll share the profit with you. So we supplied capital to their pro rata. And one of the companies we did that in, it was UiPath, which is now at 41x when we invested, which was at the third round. And so my belief is partnering with the best seed funds to supply them capital for their pro rata solves the problem of getting into the best deals.
Yeah, no, that's smart. Yeah, it's that's really clever. UiPath is one of those ones that surprised a ton of people. I always tell this story. I'll do it really briefly, but the startup that I founded was a startup in Prague and London, and one of the investors, well, the main investor in my startup, was a firm called Credo Ventures.
Yeah,
and I lost them all their money, but they got in on UiPath, so I'm very happy. I don't feel guilty anymore.
Should never feel guilty, because investors assume they're going to lose so many, 9 out of 10 at least. So never feel guilty. So Andrew, that is the unicorn story this week, which is there's lots of them. They're hard to get into, and the world needs a way to do it, especially retail investors who typically don't get in until a company IPOs. And that's what I'm trying to solve for. Very early in solving for it, but Signal Rank Capital is basically that. Thank you for mentioning it.
Yeah, I have to say, it's not surprising, and it's also a bit depressing, because it just shows that it's a winner-take-all market controlled by a few people, and that all this stuff about openness and innovation doesn't really exist. And I think Clubhouse is an example of that, in the sense that it's clearly a company that's fundamentally worthless, the garbage that's on it, and yet it's had so much visibility in press because it was backed by big money.
Sorry, Andrew, go ahead.
So the one thing that, you can't have a content company that's completely boring and uncurated and just full of people, VCs and tech people and advertising people talking about really boring stuff.
Yep. Self-fulfilling prophecy is what is the word that Steve used. And I think it's true that, if Andreessen Horowitz invests in a company, the chances of that company succeeding go way up just because Andreessen invested. If Andreessen invests along with, I don't know, Sequoia, it would be incredible if that company didn't succeed. So some investors carry so much weight that the entrepreneurs, in a way, buy time to execute simply due to their investor base. And if you've got time, you probably can get it right. And so I think that self-fulfilling prophecy, there is some truth in that. That said, ultimately, the buyer is the judge of whether you're any good. So if you're an enterprise company, you've got to sell. If you're a SaaS company, you've got to have subscribers. If you're a consumer company, you've got to have users and figure out how to monetize them. That kind of doesn't go away, but it can take much longer to figure out you're a failure if you've got good investors.
Yeah.
Andrew, you're muted.
Let's talk a little bit about this week. This was the week that crypto crashed. Finally, I've been talking about it for months. Is it a real crash, or is it just a little minor crash, then everything will come back? Steve?
Well, I own a tiny amount of Bitcoin, and I was the idiot that bought, was it 2017, the last massive, and then I lost all my money virtually. I decided to sit on it and learn about investing properly, like buying the dips or whatever. And I've held mine ever since. So I'm not really emotionally attached to the crash, or I'm just holding and seeing where it goes. And I think it will bounce back. It seems to always bounce back. What worries me is, this is what I tell people when they ask me about this, it's so ripe for manipulation. That's kind of why I ignore it. We saw the big crash this week. I'm sure it'll go back up. I don't know what caused the crash. I'm very suspicious about the deregulated aspect of it. So I think it's ripe for market manipulation. So I'm just holding and I don't know why I'm holding. I'm just amused by it all.
So I shared the wrong screen there by accident. Apologies, guys. I was going to say, interesting enough, as Bitcoin was crashing, the newsletter makes the point that, and I'll show it again now. Here it is. The dollar fell to a 3-year low as the deficit nears 2 trillion. So you've got to contextualize the crypto. I'd call it a correction more than a crash. It's a $40,000 per Bitcoin as we speak now, and it was at 20,000 a few.
What does the legendary investor Stanley Druckenmiller say about all this, Keith? He's our authority.
He is back again this week with.
He looks like a legendary investor too. Look at that face. He
attacks the Fed for its policy of printing money, which I've put alongside the story about the dollar falling. And up above is Bitcoin uses less energy than the banks use. So as you can see, I'm biased, but I do think that Druckenmiller's right, which is the dollar is worth a lot less than its share of Bitcoin. And they're going to go in opposite directions, with Bitcoin going up and the dollar going down in the near future.
Steve, do you see the Bitcoin crypto revolution as being a fundamental re-architecting of the financial world, or is it all froth? Easy question.
Yeah, I mean, I'm more inclined to think it is all froth. I think that article about the energy consumption, I think that's absolute nonsense. You can't compare. You can't say, well, Bitcoin uses less. Was it half as much energy as the rest of the financial system? Yeah, one adds a ton of value, and one, it can't make up its mind if it's, an asset class of whatever it is, storage of value, or a currency, or something else. I mean, come on.
Well,
they're incomparable.
You and Andrew are in the same camp there. I'm going to be the sole defender who makes.
Okay, but all right. Let me ask you a straight question then. What of any use have you done with Bitcoin this week?
What I've done is I've used it as a bank account. I took my salary and put it in Bitcoin, and so I use it as a bank account. So it plays the same role as my bank account plays, except I prefer it to my bank account, because if it's in my bank account, it's in dollars, which are going down, and if it's in Bitcoin, it's in Bitcoin, which I think will go up.
Okay, so that's a store of value, but presumably you haven't spent
using
it.
Yeah.
No, it's a custodial service as well. So it's got custody of my money. It's doing everything a bank does, including paying me interest, which is good.
Except for this week, right?
Well, even this week, it would pay interest. If I put it into BlockFi, I could get 7 or 8% interest on it. So it is doing everything a bank does. And if you think about the energy used to produce Bitcoin, that energy costs something. Let's say for every dollar of energy consumed to make Bitcoin, more than $1 of Bitcoin is mined. So actually the energy just gets transferred into Bitcoin from electricity.
And what about?
I read this. Yeah, I read this. Yeah, like it's a storage of energy.
I mean,
I don't buy that.
And what about the sort of the connected financial downturn in SPACs and the rest of the financial market? Steve, are SPACs history too? Are they toast?
No, I don't think SPACs are history. I think SPACs are like a perfect storm. Tech stocks are up. SPACs are a great way of going public with even less scrutiny. I think they're here to stay as long as there's an appetite for them, right? From
But is there still an appetite, Keith, for SPACs? Aren't there a lot of crappy SPACs out there, and it's sort of embarrassing now?
Well, there's always lots of crap whenever there's money to be made. So yes, you're right, but there's also lots of good ones. And so I think like App Harvest this week, a vertical farming company, produced its first results since going public through a SPAC, and its stock is up quite a bit on the week because of that. So it's all depending on the company and its performance, like anything. And so there will be good SPACs. I do actually want to say, just to agree with you, Andrew, and also you, Steve, the one asset class that shines this week is startups. The 166 unicorns are vastly more, indicative of growth of wealth than even crypto. So if you were choosing where to put your money looking forward, I think startups are a good place, except most ordinary people are excluded from investing in them.
Yeah, no, I get that, but isn't that really because startups are creating like actual value?
They're creating actual value, yeah.
And that's what I think when markets don't reflect value is when you have a problem.
Yep.
And when you say ordinary people, I mean, what does that mean? If you show up to all the TechCrunch events, you can still get in really early here.
No, you have to be a qualified investor, which means you must have over $200,000 of annual income or over $1 million of net worth aside from your house.
Well, who else is? I mean, if you don't have that, then you can't be an investor. Well, you just people who live hand to mouth are not going to be. They're not thinking of investing in startups. They don't even know what a unicorn is.
No, they're all on Andrew. They're all on Robinhood investing in public companies because they're excluded until that stage.
Or on Coinbase, right? Whatever.
Or on Coinbase, yeah.
They're all investing in these sort of so-called.
And they're the ones who will get screwed, right? As always. Yeah. And the Andreessen Horowitzes and the Sequoias, as you say, betting on themselves, and it's a closed market. So this idea of innovation being democratizing is one of the great myths.
But if you could invest in a vehicle that was able to get in on the best seed deals by following those early signals, then that would work. But if you're going to invest in a firm that can't get in on those deals and only gets in the second, third, fourth tier, then you're sort of back to square one. You might as well go back to equity crowdfunding.
Well, we're in the fifth tier on this show. We're with Keith tier. I couldn't resist that, Steve. What about, Keith, the other area that's hot, life, death, and streaming? Is streaming the new crypto?
No, well, definitely not the new crypto. Streaming is it's the new disruption, though. AT&T this week announced that it's selling Warner Media into a merger with the Discovery Channel, and that includes HBO, CNN, and a whole bunch of really valuable assets. And this is only a short while after it previously bought the same assets for $50 billion more than it's getting in value by selling them or merging it. So what is the story? The story is non-media companies thought that they could add streaming to their pipe business, selling bandwidth. Turns out they don't know what they're doing, but streaming itself is just taking over the broadcast world. So streaming has won, but no one yet knows who's won streaming. And so that's how it's set. We cover a bunch of stuff, including the AT&T merger. and a great O'Malley piece, by the way, called Weapons of Mass Value Destruction, which is all about how when telephone companies buy media, they lose money. So that is a pretty big trend this week, and topical. And of course, because we're now.tv, we care about this. You're muted again, Andrew. Andrew, you're muted.
Sorry. One thing we can say for sure is that anything associated with AT&T or Verizon is by definition a piece of shit, right?
Oh, no, I don't know about that. TechCrunch was part of Verizon.
Yeah, but that has nothing to, but then they saw that has nothing to do with Verizon. It was made before Verizon got its dirty hands on it.
I mean, when I worked there, they issued me a laptop, Verizon, so kind of important.
Was it Windows or Mac?
No, it was a Mac. It was a Mac.
What's your take on the streaming wars, Steve? Any? It seems fairly self-evident that everything now is shifting to over-the-top streaming, and that subscription. I mean, can television? I mean, we've been talking about this for years, but why would anyone subscribe to DirecTV or any of the other platforms?
Yeah, I don't think they will. I mean, I'm surprised how well Disney Plus is done. That's quite surprising to me. But Keith, didn't you write somewhere, or you said somewhere that you think people are going to stop wanting to pay for like bundled streaming? They want to unbundle again. Yeah, do you really think so?
Well, I think what I'm really saying is people do want to buy bundles, but they want the bundles to have stuff that they actually watch. They don't want to pay for stuff they don't watch in the bundle.
Okay, but how would that work?
Not surprising, is it? Let's move on. So we've done streaming, we've done Bitcoin, we've done SPACs. Startup of the week, Keith. Interesting company, I thought, this week.
Yeah, well, I'm going with the theme of startups trying to save dinosaurs. And the dinosaur in question here is banks. So a company called Amount, which has a job of helping banks modernize and compete with fintechs, has raised $99 million Series D at a unicorn valuation. So it's my startup of the week because somehow it managed to persuade people to give it money, even though its goal is to save the dinosaurs.
I mean, this is my area, my special area of interest, with the challenger banks. And I don't know about this particular company, but the mistake that people make when they analyze the space is it's not really about the better user interface, right? Or the better kind of customer experience. The secret to challenger banking is they don't have the legacy cost base, right? It's actually the fact they don't have huge technical debt under the hood, and they don't have brick and mortar stores. And like in the UK especially, it's quite hard for an incumbent bank to overnight say they're going to shut X number of stores and make people redundant. Like, that's not really going to happen. So really the advantage to the challenger banks is just a significantly, like, orders of magnitude lower cost base. And all of the lovely interface stuff, the banks always copy it. Like, a couple of years later, they copy all the best features, but they can't lower that cost base. So I think that's the bet.
That is the bet. You will remember. Listeners might not remember this, but I am British, and my first bank accounts were all created when I was in college. And for decades now, I've had a First Direct account, and First Direct was one of the very first. It's owned by HSBC. It's one of the first banks that didn't have physical banks anywhere. It was a purely virtual organization, and that goes back literally 30 years ago or more, and it still exists, and I'm still a customer. So I wonder whether Amount is doing anything different to what First Direct did then.
And what about the tweet of the week, Keith?
Yeah, we run out of time, so Andrew's moving us along here. Tweet of the week. You love this one. With more than $1 billion invested in the sector so far in 2021, the going public via SPAC continues growing in popularity with agriculture and food tech companies, particularly those involved in indoor and vertical farming, which, as you know, I am. I have the title SVP and Head of Corporate Development at Infarm. And I added a couple of articles about vertical farming, one from Sifted and one from Crunchbase that covers the vertical farming network. So I thought this was a good tweet of the week because it's something I actually know about.
Who's Cami Reffer?
I have no idea. Should we click on it and see? Cami Reffer is, I'm going to tell you now that you've asked, he's at Moss Adams, which actually, funnily enough, is my accounting firm that does my tax returns.
See, it's all a network.
It's all a network.
Yeah.
Self-propelling prophecy.
So Steve knows a bit about vertical farming, right, Steve?
Yeah, I think I was probably one of, if not the first journalist to cover it in farm, I think. And what's interesting about some of these plays is they put these modular farming units, kind of Internet of Things meets farming, like in consumer facing places. So they put like some of these units in actual grocery stores or supermarkets, and that was all very fun and very clever. But my bet was that this was not going to be the way, and that actually these vertical farmers were going to move into quite big warehouses, sort of still relatively close to population density, but not really. So I think the long term. Go on.
Does it represent the end of traditional agriculture? Does it mean that in the end everything's going to get produced in warehouses?
No, because technically some things can't, but a lot of things are. I should just say I've been involved in Infarm since I met the founders in Tokyo, and I was the judge of a startup competition, and they were the winners back in 2015. And I invested in the company in their seed round, and they're now $300 million plus later, having raised.
They're paying for this event.
They
we should get them as a sponsor. Can't they give me some free vegetables?
They can.
I like carrots and broccoli and asparagus.
They don't do veg yet, do they? They don't
no, they do leafy greens, herbs. You know, they're going to do tomato, spinach, lettuce. They're going to do the next two crops are tomatoes and mushrooms. But ultimately, they'll grow a lot. And their modularity is interesting because they can glue together farms up to millions of square feet. So modular doesn't mean small; it just means highly flexible.
The PR line was always like, it's like AWS, right? You can spin up another module and then as big as you want.
And they're focused on urbanization. If you look at the urbanization numbers, especially in Asia, cities are sucking the countryside into them. And farming is a massive carbon negative because of transporting food to the cities. So ultimately, for lots of produce, this is a great climate change ESG play, as well as a very profitable one.
And to go full circle, their seed investors were Local Globe and Cherry. All right. Yeah.
Yep.
I remember when I first spoke to, I think, the investor at Local Globe, my reaction was, this is just bonkers enough that it might work.
Well, can they legitimately be called could you be a seed investor in an agricultural startup?
Oh yeah. You can.
Good pun, Andrew. What?
Good pun.
Yeah. Well, they're growing something spectacular. It is an interesting space. It makes sense, actually.
On that note, if Andrew's being optimistic, we've got to end the show right now.
I believe in agriculture, in reinventing agriculture. We've reinvented finance and banks and streaming, but agriculture is the real thing. That was a great show, Steve. Thank you so much for spending your time coming on, and best of luck with everything, especially your new gig. Sounds really interesting, and we'll have you back on again. And Keith, have a great week, and we'll see you next week. That was the week for May 20th, 2021. See you, everyone.